All right, let's talk some cars here. I want to bring in Garrett Nelson. He's an equity analyst at CFRA Research, and we're going to do some trading with Kevin Hanks here in studio. Garrett, good to have you on this morning. Let's talk some big picture geopolitics and what it means for the autos. We've seen companies like General Motors specifically cite tariff prices in their guidance. We've seen it with Tesla on the China relationship. But what does that mean in the way you have gone through the companies? I mean, can we really determine what it means for them just yet?
So it's still a developing situation, and it's kind of a wait and see. We're kind of in a wait and see phase right now, but it's really unprecedented what we're seeing. I mean, entire industries are being used as bargaining chips between countries, and the auto industry is certainly right in the middle of it. One thing we would say as it pertains to the U.S. and China, the U.S. doesn't export a whole lot in terms of auto vehicles and parts to China, relatively speaking. So they U.S. exported about 170,000 vehicles last year, which was down from about 270,000 vehicles in 2017 to China. So the total value of those exports last year was a little under $7 billion. And to put that in the frame of reference of the China auto industry overall, China is the world's largest auto market with sales of about 28 million vehicles last year. So those 170,000 vehicles was less than 1% of the overall market.
So in terms of the greatest sort of risk posed, which company does have that most exposure if this thing goes south? Is that kind of your point here, that look, when you just look at it based on sales, that there's the easy answer?
That's right, and it's really two companies stand out. General Motors, China accounts for about 4 in every 10 vehicles that they sell worldwide, so they probably have the most China exposure. And then Tesla, going forward, they're very close to finishing their new factory in Shanghai.
Yep.
China accounts for about 10% of their total revenues today, but that percentage will be increasing significantly when this factory is up and running by the end of the year.
All right, Garrett, let's walk through one of the cases you've got here on the bullish side. Fiat Chrysler looks like one of your more conviction buy ratings. Tell me why that right now looks to you better than even a classic like Ford that has been, trying to streamline and go to the high margin stuff.
So we think Fiat Chrysler is the most attractively valued of the major U.S. automakers. They hardly have any Asia exposure, so they're mostly a North America and Europe play. And their vehicles have been selling very well compared to their competitors.
Okay.
Ram pickup trucks are up, sales are up more than 20% in the U.S., and they have the Jeep brand, which is very strong. So we like how they're positioned relative to General Motors and Ford and Tesla as well.
Tell me about Ford, because it's one of those companies where it seems like the market is perceiving maybe kind of a bottoming of its business. It hasn't really taken off, but it still has had a pretty good little run in a few spats over the last year as the company seems to figure out that some of their cars don't make sense in today's market. Some of them do. It seems like their vision has been at least more specific and narrowed. Is that a good thing? What does Ford really need to kind of return to glory, or even if it never does, return to something that's a buyer in your eyes?
Sure, we think they need to execute. They're coming off a very disappointing quarter. Their earnings fell well short of consensus, and they put out very disappointing full-year guidance. So we're looking for them to execute. However, we do like their dividend yield. It's yielding over 6% here. We do think that dividend is secure. We just don't see upside in the share price. So we're looking for some execution from them.
Yeah. What will that look like to you? Is it just absolute revenue, sales, that the cars that they're making are competitive in today's landscape, or is it something more structural where they're going to be, wringing more out of the actual manufacturing process and the margins?
So I would say it's a combination of both top line improvement, where they've actually been losing a lot of market share in the pickup truck segment to Fiat Chrysler with the Ram truck. So we look for improvement in sales combined with cost reductions. So, those two things, and, looking for some margin expansion on, driven by those two factors.
Garrett, what about general macro risk? Right now, you've got a market that is grappling with all of these numbers coming out of Germany, also obviously a big car exporter where those numbers have declined pretty dramatically. But general economic weakness, will it hit here? That's the big question everybody wants to know. How does the trajectory for the economy affect the kind of value proposition for each of these three companies? Is any one particularly prone to struggle the most if things do slow down?
Sure. So historically, automakers have performed very, very poorly late in the business cycle.
Right.
We think that's where we are today. It's not clear if there will be a recession in 2020 or 2021 or when that's going to happen, but we're seeing very sluggish sales in the U.S., more so in Europe, and then China is just in a very bad place right now. Their auto sales are down 11% year to date. That market had grown for 3 decades straight almost until they had a slight decline in auto sales last year. So overall, in those major markets, we're seeing pretty significant slowdown in sales, especially in China.
All right, Garrett, last point here on Tesla, because when we talk cars, we got to hit Tesla. Is there also economic risk here? I mean, if this is a sort of premium car and a company that needs to sell cars, ideally at a higher end of their price range, are they also poised to struggle if the economy does not remain robust?
Yes, we think so. And another major risk here that they really haven't had in recent years is they're facing a lot of competition. At the New York Auto Show a few months back, there were 40 new electric vehicles, either hybrid or fully electric vehicles. A lot of those will be hitting the market in early 2020. So we're only months away from that happening. Specifically Audi and Jaguar and BMW, those models we think will be very competitive with Tesla, and their balance sheet is a mess. I mean, they have so much debt on the balance sheet. We're not real optimistic, and not a whole lot in the pipeline aside from this new factory in China, which will be starting up by year end. There's just not a lot that we see in terms of near-term catalysts.